Well, good afternoon, everyone, and welcome to this Pitcher Partners webinar. My name is Craig Watman. I'm one of the tax partners here at Pitcher Partners Melbourne and the head of our transaction taxes team. Thanks very much for joining us this afternoon. I'm also joined by my colleague, Irina Tan. Irina is a client director in the taxation team here at Pitcher Partners. Just a bit of housekeeping before we get underway. We will be taking questions. We do intend to have some time for questions at the end of this session. You will see a Q&A button on the bottom of your screen. Hopefully, please feel free as we go through the presentation to enter your questions into that box, and we'll be monitoring those as we go along and hope to get to as many of your questions as possible at the end of our presentation. We will be sending a link to the slides and the recording out to you all within 3 business days. So please watch out for those, and you're welcome to share those with any of your colleagues and other people if you would like to. So this is a seminar about the windfall gains tax. It's a new tax, and it's been a very controversial one since it was first announced by the Victorian government earlier this year. As it so happens, the legislation to give effect to this tax has just earlier today, in fact, received royal assent. So the legislation has passed and has received royal assent. So we do now have legislation in place. Obviously, it's not coming into effect just yet, but it is done and dusted in terms of being the law, so to speak. So the way this presentation will go is that I will be handing over to Irina shortly. Irina will take you through the operation of the windfall gains tax, the different mechanisms for how it operates. And then Irina will hand back to me. I'll take you through a couple of examples. We'll also have a look at some of the issues of concern that we've already identified in our review of the legislation and thinking about how it will impact you, our clients, moving forward. We'll then discuss just some watch outs for the future. And as I said, then we will have time for your questions at the end. So please do use the Q&A box for your questions. But with that, I will now hand over to Irina. Thank you, Irina.
Thanks very much, Craig, and good afternoon, everyone. Thank you so much for joining us today. And it's too bad we can't see everyone today, but we look forward to seeing you in person, and hopefully you are keeping well in the meantime. We've got a lot of ground to cover today, so I think we should dive right in. As Craig said, the windfall gains tax is a brand new property tax in Victoria, and it's one that will commence on the 1st of July 2023. So there's still some time to go, but unfortunately the bill, as Craig said, has passed and it's done and dusted from that perspective. This new tax will apply when there is a rezoning of land and where that rezoning is not of an excluded type, and where as a result of that rezoning, the value of the land goes up by more than $100,000. The liability for the tax will be triggered at the time that the rezoning takes effect under the Victorian Planning and Environment Act. And in terms of its history, just briefly, the windfall gains tax was first announced on the 15th of May, 2021. And at the time, very limited information about the tax was available. There was a media release, there was a 1-page fact sheet, there were a few mentions in the Victorian budget papers. And if you attended our webinar back in June, you may remember us sharing with you what we knew then about the tax, which wasn't much, unfortunately. And at the time, there were many unknowns, including, who exactly would be liable for the tax, how a windfall gain will be calculated, whether there are any transitional exemptions or relief, whether there are any other general exemptions, and whether there's any scope to defer the tax, and if so, how the deferral would work. It was not until the 13th of October that we actually saw the bill and the details regarding the scope and operation of the windfall gains tax, including the tax base, the deferral mechanisms, the transitional exemptions, and of course, we also found out about the revised commencement date of the 1st of July, 2023, which is a year later than the original planned commencement date of the 1st of July, 2022. Now, in terms of the rate, the maximum tax rate is 50% of the uplift or the increase in the land value as a result of the rezoning. And these rules, just to note, they're quite complex and technical and obviously very new. So given the potentially very significant costs of the windfall gains tax, naturally care must be taken in ensuring that the rules are understood and applied correctly. And on that note, we'll now spend some time going through the key features of the tax. And as Craig mentioned, after that, he'll then take you through a couple of examples dealing with the various features of the tax as well as the issues of concern. Now, if we move on to the next slide, we will now look at what land will be subject to the windfall gains tax. So any land in Victoria that is rezoned other than under an excluded rezoning may be subject to the windfall gains tax if the value increase as a result of the rezoning is more than $100,000. In terms of what an excluded rezoning is, well, they are listed there on the slide. The first one is a rezoning between schedules in the same zone. So for example, if there's a rezoning that moves the zoning of the land from a neighborhood residential zone schedule 2 to a neighborhood residential zone schedule 1, then that's an excluded rezoning that does not trigger the windfall gains tax. The second one there is a rezoning to the urban growth zone within the growth areas infrastructure contribution or GAIC area. And the third one there is the first rezoning after the 1st of July 2023, so after the tax commences formally, of land that was in the GAIC contribution area before that date. The fourth one is a rezoning to a public land zone or between different public land zones. And last but not least, it also captures other rezonings that the Treasurer may declare to be excluded rezonings in the Government Gazette. And in relation to this, we've already heard that one such rezoning will be a rezoning to a rural land zone, other than a rural living zone. But there may be other rezonings that may be declared as excluded rezonings, and we will watch and see what else the Treasurer may declare to be excluded. In terms of, we'll now move on to the next slide, where we will now look at who is liable for the windfall gains tax. It's the owner of the land at the time of the rezoning who's liable for the windfall gains tax. And where there are multiple owners, then all the owners would be jointly assessed for the windfall gains tax without taking into account their separate interests. Where land is held on trust, the trustee will be assessed for the windfall gains tax without regard to any land that the trustee might hold for other trusts or for the trustee's own benefit. There are grouping provisions, unfortunately, where members of a group of related corporations, trusts, or a combination of related corporations and trusts are jointly and severally liable for the windfall gains tax on all the land held by members of the group that is rezoned by the same relevant windfall gains tax event. The grouping rules, I should note, are quite broad, and they're broader than the equivalent rules that appear in the land tax legislation for land tax purposes. In particular, the grouping rules for windfall gains tax purposes capture related trusts, whereas for land tax purposes, it only captures related corporations. The grouping and aggregation provisions are, as you may have already worked out by now, they're there so that the tax-free threshold of $100,000, which we'll look at shortly, applies only once to properties owned by the same owner or group of related owners and rezoned under the same rezoning event. Now, based on the relevant rules as they currently are or appear, the rules indicate that each entity that technically fall within a group is liable jointly and separately for a windfall gains tax liability that arises in relation to the land of a member or members of a group, regardless of whether that entity has any land or land that is part of the windfall gains tax liability, or basically land that was rezoned under the same rezoning event that triggered the windfall gains tax liability. So in our view, clearly that's not appropriate, but unfortunately that's how the rules are at the moment. It is quite unfair that members that don't own any land or own any land that contributed to the liability are jointly and severally liable for a liability arising in relation to land held by another entity within the same group. In terms of how the windfall gains tax is calculated, on the next slide, please. It's calculated using the following approach. So firstly, you work out the aggregated value uplift in relation to the land. And that basically is the difference between the capital improved value of the land immediately before the rezoning. So you might hear it commonly referred to as CIV1, capital improved value 1. And the capital improved value of the land immediately after the rezoning, which is commonly referred to as CIV2, capital improved value 2. The formal CIV1 will be based on the most recent general rating valuation for rates and land tax purposes. And the latter, CIV2, will be basically determined through a supplementary valuation by the valuer general or a valuer nominated by the valuer general. You then do that for all of the land of the landowner or all the land held by a related group that's rezoned by the same event. And again, this goes towards the aggregation and ensures that the owner or the group cannot claim multiple tax-free thresholds. Secondly, you then deduct allowable deductions from what you get from step 1. Unfortunately, this detail regarding what can be deducted, that's actually not in the legislation yet. Instead, it's clear that it will be dealt with by way of regulations that the Governor in Council can make under the windfall gains tax law to give effect to certain aspects of the legislation, including the scope of allowable deductions. Now, we hope that the scope of deductions would be reasonable enough to include obvious costs directly associated with the rezoning activity, such as any remediation costs and the cost of engaging planning experts, as well as landholding costs such as interest and land tax. But we'll need to wait and see what's actually put in the regulations in terms of what can constitute allowable deductions. Now, after steps 1 and 2, you then multiply what you get as a result of steps 1 and 2 by the relevant windfall gains tax rate, which we'll have a look at in the next couple of slides. If we hop on now to the next slide, this one talks again or reiterates how, again, you work out that taxable value uplift. Again, it's taking the CIV1 or the pre-rezoning CIV and deducting that from CIV2, which is the post-rezoning valuation. Basically, the CIV2 valuation is conducted as at the same date as CIV1, but as if the new zone resulting from the rezoning was in place at the time. So by way of a simple example, if the previous valuation of CIV1 was made as at the 1st of January 2024, and the land was, say, rezoned on the 1st of July 2024, the supplementary valuation would need to assume a 1st of January 2024 date, but with the rezoning assumed to be in place, even though it wasn't in reality. And the government stated that this should, in theory, ensure that market increases not related to the rezoning are not captured or subject to the windfall gains tax. But practically, I think it's an exercise that will lead to significant dispute and disagreement between the State Revenue Office and affected landowners. The other thing too is that because the CIV2 is a rezoning done by the valuer general or a valuer nominated by the valuer general after a rezoning event occurs, there's no certainty of knowing the size of the uplift and the windfall gains tax payable in advance. And therefore, the liability is simply not known until the valuer general or his nominated valuer actually undertakes that supplementary valuation. So basically, it's just going to be very difficult for landowners and people looking to transact with landowners to work out how much to price into the relevant arrangement because they just don't know what that windfall gains tax is going to be in advance of that supplementary evaluation actually being undertaken. If you move on to the next slide now, we see here a table of the rates, which basically depend on the size of the uplift in the value of the property. As mentioned before, the maximum rate is 50% of the uplift, and that applies when the uplift in value is $500,000 or more. Under that amount, the first $100,000 is tax-free, and the rate is 62.5% of the uplift above $100,000. So that's phasing in, if you like, for properties or with value uplifts below $500,000, and beyond that, it's a flat 50% of the full uplift without the benefit of the land tax, tax-free threshold. The next slide we go to now talks about when the windfall gains tax will be payable. As I said before, the liability is triggered at the time the rezoning takes effect, and the landowner of the land at the time is the one liable for the windfall gains tax. And basically how it works is that the landowner will be issued with a notice of assessment by the Commissioner of State Revenue for the windfall gains tax liability. And the assessment will have a due date for when that tax is payable. And basically the windfall gains tax will be payable by that date. But the good news is that before the due date on that assessment, the landowner will have the option to elect to defer the payment of up to 100% of the windfall gains tax assessed in the assessment. Unfortunately, outside of the deferral mechanism that I mentioned then, the legislation provides no discretion to the Commissioner to extend the time for payment of windfall gains tax or to accept payment of windfall gains tax by installments, as the Commissioner may do for other revenue lines, such as land tax, for example. The windfall gains tax doesn't require a dutiable transaction for the liability to arise. So because it arises as a result of a rezoning, it effectively taxes unrealized capital gains, if you like. And therefore, many landowners are unlikely to be able to pay the windfall gains tax when it arises. And the deferral mechanism was introduced to address the concern regarding the ability to fund the windfall gains tax. To secure the SRS interest, a first charge will be placed on the land in respect of any unpaid windfall gains tax and any accrued interest. And this charge will take priority over all other encumbrances over the land and would therefore rank ahead of a financier's mortgage, even if earlier in time. We go on to the next slide now. We'll talk a little bit more about how the deferral works. It works this way, that the payment is deferred until one of the following events, whichever occurs first, happens. So the first one is where you've got a dutiable transaction other than an excluded one, and we'll have to look at what that means shortly. The other event that could end the deferral is a relevant acquisition. So that's talking about an acquisition that's captured by the landholder duty provisions under the Duties Act. Some of you might know it, also refer to it as the land rich provisions. So if you've got a transaction that triggers a liability under those provisions, that will also, or that can also end the deferral. And the last one is, maximum of 30 years after the windfall gains tax. Basically, in other words, you've got a maximum of 30 years. That's the sort of fullest extent. But it's likely that a dutiable transaction or relevant acquisition for landholder duty purposes will actually end the deferral first. And where the landowner elects to defer payment of the windfall gains tax, the deferred liability will accrue interest at the 10-year Treasury bond rate, applying from time to time. I think as at the 31st of October, the rate was 2.38%, but obviously that will sort of move over time. And who knows what that rate will be come 1st July 2023 onwards. Where the land is subject, where land you've got is subject to deferred windfall gains tax and accrued interest, and that land is subdivided, the windfall gains tax and interest are basically rolled over to each subdivided lot and apportioned by reference to the size of all lots created by that subdivision. I think we'll move on now to the next slide. And this is about what happens once the deferral ends. And once the deferral ends, basically that deferred windfall gains tax liability plus the accrued interest must be paid to the commissioner within 30 days of the event that stops the deferral. Again, excluded dutiable transactions and excluded relevant acquisitions do not cease the deferral period. And we'll now have a look at what that means on the next slide, please. Excluded dutiable transactions include the acquisition of an economic entitlement in relation to land as governed by the Duties Act 2000. It also includes a transfer to a deceased person's legal personal representative. It also includes a dutiable transaction which occurs for no consideration, but only where the transferee to that transfer elects to assume the liability for the deferred windfall gains tax and interest. Last but not least, transfers of land by a charity to another charity may also be an excluded dutiable transaction, but the same requirement applies in that that transferee charity will need to elect to assume the liability for the deferred windfall gains tax and interest. The next slide we'll go to is about what excluded relevant acquisitions mean. The first one there is an acquisition that occurs solely due to a pro rata increase in the interests of the relevant shareholders or unit holders as governed by the Duties Act 2000. So again, because the concept of a relevant acquisition is linked to the landholder duty provisions, I guess the concepts as well of the excluded relevant acquisitions will need to be relevant to or be linked to those provisions in the Duties Act, even though we're talking about the windfall gains tax here. The second one there is a relevant acquisition of a further interest in the landholder within the meaning of the landholder duty provisions in the Duties Act. So it's great to see that there's recognition there in the deferral provisions that landowners are unlikely to have the capacity to fund the entire windfall gains tax liability at the time of the liability arising, and will have the option to defer the windfall gains tax until the property is basically sold or transferred, such as any cash flow issues should be mitigated there. But there's still alignment, there's still issues with the alignment of the deferral with the cash flow. So for example, if you've got an in-specie transfer of units in a unit trust that owns land that has been rezoned and that has triggered the windfall gains tax liability, based on the rules that we have here, that will actually cease any deferral opted for in the first place, notwithstanding that in-specie transfer of the units occur for no consideration. And that's because under the scope of relevant acquisitions here, you'll see that it only excludes acquisitions that occur solely due to a pro rata increase or an acquisition of a further interest. It doesn't include other type of landholder duty transactions that occur for no consideration. On the other hand, if instead of a transfer of units, you had a transfer of the underlying land for no consideration, assuming that the transferee elects to assume the liability for the windfall gains tax and the interest, then that deferred liability will remain, that deferral will remain in place. So clearly there's a mismatch there between the shape of the transaction and whether or not the deferral put in place will come to an end. Last thing I'll note in relation to this slide is that, again, because the deferral rules depend on concepts linked to the Duties Act 2000 in Victoria, which can be very complex by itself, a strong understanding is therefore required not only of the windfall gains tax rules to work out the scope of the deferral rules here, but you need to also look at the rules under the Duties Act. So it's unlikely that the windfall gains tax will be analysed in isolation, and it's likely that you need to look at the Duties Act as well as the Windfall Gains Tax Act. If we now move on to the next slide, in terms of the rights of objection, basically taxpayers will have the right to object to the valuations made for the purposes of the windfall gains tax assessment, and taxpayers will have 60 days to to object to that assessment. And importantly, the legislation provides that the commissioner will have no discretion to allow a late valuation objection to be lodged by a landowner, which is different from the position in respect of other state taxes such as stamp duty. Further, taxpayers should also have the right to object to the imposition of the windfall gains tax on other grounds, such as on the basis that there is an entitlement there to an exemption, but that the commissioner simply has not applied that exemption correctly. Outside of the Taxation and Administration Act, taxpayers will have a right to object to valuations made by a valuation authority under the Valuation of Land Act within 2 months of receiving the assessment of the windfall gains tax. We'll now look at the transitional exemptions on the next slide. Basically, windfall gains tax is not imposed on land where the rezoning was underway before the 15th of May 2021, provided that the relevant requirements are met. And the requirements are that before that date, so again, 15th of May 2021, which was the date that the windfall gains tax was originally announced, as we mentioned earlier, the owner must have approached the council or a planning minister to request a rezoning, and the owner did relevant work or incurred relevant costs for or to support the rezoning with a total minimum value of $100,000 or 1% of the capital improved value of the land immediately before the rezoning event, whichever is less. And the relevant planning scheme amendment constituting the rezoning was prepared by the council or at the request of the planning minister. And that amendment request was created and registered in the amendment tracking system before that date, or the planning minister agreed to the amendment before that date. Fortunately, the government has now confirmed that in terms of looking at the actions taken by an owner before the 15th of May 2021, the government's happy to look at the actions undertaken by someone acting for the landowner pursuant to a development agreement. So if you've got a developer undertaking those actions, such as approaching the council, undertaking those works, incurring those costs pursuant to a development agreement, those activities can count towards working out whether this transitional exemption is available. We now move on to the next slide. This is about the transitional exemption that is available for certain contracts of land, contracts of sale. So this applies where the contract of sale is entered into before the 15th of May 2021 and was not completed by a transfer of land before the windfall gains tax event occurred. So in other words, to qualify for this transitional exemption, the completion of the contract or the transfer of the land needs to occur after and not before the relevant rezoning. On the next slide, you'll see that there's a similar rule for options to enter into a contract of sale. The requirements are broadly consistent in that the option must have been entered into before the 15th of May 2021. In addition to that, the terms of the contract must have been settled at the time of the grant of the option. And similarly, the option must not have been exercised, so the transfer of land must not have occurred before the windfall gains tax event occurred. So again, in other words, to qualify for this exemption, the completion of the option or the transfer of land needs to occur after and not before the relevant rezoning. We'll now have a look at the other sort of exemptions and waivers. So the first one there is for residential land, and windfall gains tax is not imposed on up to 2 hectares, which is 20,000 square meters of residential land, whether on 1 or more titles, or primary production land that includes a residence fit for occupancy at the time of the rezoning, or where a building permit for the construction or renovation of such a residence has been issued and other requirements are met. this exemption is available regardless of whether the dwelling is the owner's principal place of residence. So thankfully, it can include investment properties or holiday homes. The next one there is about rezoning errors. Thankfully, windfall gains tax is not imposed if the rezoning that constitutes that windfall gains tax event is caused by an amendment to correct an obvious or technical error in the Victorian planning provisions or a planning scheme, and where there was a previous windfall gains tax event and the windfall gains tax was assessed on the previous event and the correction results in a negative value uplift, the Commissioner must reassess the original windfall gains tax event, and the owner of the land is entitled to a refund of the windfall gains tax and interest paid on the original event, provided that the owner of the land at the time of the correction is the same as the owner of the land at the time of the original windfall gains tax event. The last one there relates to charitable land, where the Commissioner must waive any windfall gains tax and accrued interest payable in respect of land owned by a charity that is used and occupied by the charity exclusively for charitable purposes, if the land remain charitable land continuously for 15 years after the relevant windfall gains tax event, and where only part of the land has remained as charitable land for the 15-year period, then only that part of the land would basically qualify for the waiver. And so it's proportionate in that sense. Now, charitable land that is subject to the 15-year use requirement for the charitable land waiver can be transferred to another charity and still be entitled to the waiver. And basically, to get that, as I mentioned before, that new charity must elect to receive the land with the deferred windfall gains tax liability and any accrued interest, and it must also commit to using the land for charitable purposes. And unfortunately, if the land ceases to be charitable at any time during the remainder of the 15-year period, the waiver will no longer be available and the usual deferral rules will apply. And now we've gone through the basic features, if you like, of the new tax. And at this stage, I'd like to hand over to Craig. Over to you, Craig.
Thanks very much, Irena. So Irena's covered very well all of the operational mechanisms of the tax. Hopefully now you have a good understanding of how it all works. And I can see that we've already got a few questions that have come through on the Q&A that we will definitely get to at the end of the presentation. So please feel free if you haven't done so already and you've thought of a question in relation to how the tax works and how it might impact a particular project that you've got going on at the present time, feel free to pop that question into the Q&A function. So now we'll move into looking at a couple of examples about just seeking to apply those mechanisms that Irena has discussed to a practical situation. So the first one is we've got Susan, who has entered into a contract to sell her 40 hectares of farmland near Geelong to a developer. That was in 2021. And in 2024, that land is rezoned from the farming zone to the general residential zone 1. And the contract of sale with the developer settles and the land is then transferred to the developer. So if windfall gains tax is payable, and we'll get to that shortly, then the figures we're looking at here is we've got a pre-rezoning CIV value of $5 million, a post-rezoning CIV value determined by the Valuer General pursuant to that valuation process that Irena referred to of $40 million. So the value uplift being the difference is $35 million. What will then be deducted from that for the purposes of the liability calculation are these allowable deductions. And as Irena mentioned, at this stage, we have no idea what will be included within the list of allowable deductions because that list is not in the legislation itself. It will be made by way of regulation, and we expect that most likely at some stage next year. And obviously we will be advocating as hard as we can for as broad a list as possible of allowable deductions to ensure that all of the relevant costs that have been incurred by the landowner in respect of the rezoning process, etc., are taken into account and are therefore deducted from that value uplift. But for the purpose of this example, let's assume that the allowable deductions total around $1 million, and therefore that leaves us with a taxable value uplift of $34 million. So based on the rates that Irina showed to you, it would be a flat 50% of that taxable value uplift that would be the windfall gains tax liability, giving a liability in this case of $17 million. So just looking at whether that is in fact going to be payable and when it would be payable, there's a couple of issues that we need to look at here. Firstly, we've said that Susan entered into the contract of sale in 2021. So the first question is, what date in 2021 was that contract entered into? If the contract was entered into prior to the magic transitional cutoff date of 15 May 2021, then that contract is potentially within the transitional exemption provision that Irina referred to, that applies to both contracts of sale and options that are entered into prior to that date of 15 May. However, the trick then becomes when the settlement occurs and when the transfer of the land is made to the developer. If settlement occurs prior to the rezoning of the land, then the exemption is not going to apply, because the exemption states that it will only apply where completion of the contract and settlement occurs after the rezoning event. So in this scenario, the land's being rezoned in 2024. Susan would only have access to the transitional relief from the windfall gains tax if the settlement of her contract of sale with the developer occurs after that date in 2024 that the land is rezoned. If settlement occurs before that date, the exemption will not be available, and Susan would then be subject to a windfall gains tax liability and would then need to consider her deferral option. So just looking at that, let's assume that the contract was entered into after the 15th of May, on or after the 15th of May, so we're not within the transitional relief, and the rezoning then occurs in 2024. And so there's going to be a liability, and the question is, who is going to incur that liability, and will there be an opportunity to defer? So if the rezoning event occurs at a time before completion of the contract, when Susan is still the owner of the land, then she will have an opportunity under the deferral provisions to defer her $17 million windfall gains tax liability to a later date. And that later date would be the date of completion of the contract of sale, because as at that date, that would be a dutiable transaction. A dutiable transfer of that land to the developer would occur, and that is one of the events that would cease the deferral of the windfall gains tax liability. So on the date of completion of that contract, Susan's $17 million liability would crystallize, and she would have 30 days to pay that to the State Revenue Office. So obviously, it would be very important in that scenario for Susan to have taken that into account in setting the price for the sale of the land to developer. But the problem is that in 2021, when Susan enters into the contract, it's going to be very difficult for her to know what the amount of that liability is going to be, because it's very difficult for her to know what the value uplift is going to be in 2024 when that rezoning event occurs. And therefore, it's easy to sit here and say, okay, at the time Susan enters into the contract, she should be thinking about the fact that there could be a windfall gains tax liability on rezoning that she's going to be liable for. And yes, she will be getting the proceeds of sale from the developer, but she needs to factor in that liability into the price that she's agreeing to with the developer. Easy in theory, very difficult in practice. And we're already seeing a number of our clients that are facing that exact situation at the present time of really struggling to know how to deal with contracts of sale and options and other arrangements they are entering into on a go-forward basis in relation to land that will be rezoned and will be subject to the tax in the future. So if in fact settlement does not occur, if in fact settlement occurs before the rezoning event, then at the time of the rezoning event, the developer would be the owner of the land. The developer would then be subject to the windfall gains tax liability of $17 million. So hopefully the developer has factored that into the price that they have been prepared to pay to Susan under the contract of sale. And then in terms of the deferral option available to the developer, they would have the option to defer that windfall gains tax liability to the next relevant event. And in this case, if their intention is to develop this land near Geelong into residential lots for sale, then effectively that liability should be able to be deferred until they start settling the individual contracts of sale of the residential lots to the consumers who purchase them. And effectively the way the legislation works in that regard is that the windfall gains tax liability would be spread on a proportional basis across the settlements of the residential lots. So that's the deferral mechanism, and that's all the sort of different scenarios that can occur. And you can see how complicated that can potentially be given the time gap between the entry into the contract and the time at which the rezoning event occurs, and then the time at which the deferred liability actually crystallises. The other point worth noting here is that for a number of these properties, such as this one, Susan's property near Geelong, there could well be a residence on the property, and Irina referred to the 2 hectare residential land exemption. So to the extent that Susan does have a residence that she's been living in on this property that's part of the sale to the developer, then the first 2 hectares of the 40 hectares would be entitled to an exemption from the windfall gains tax, and that would effectively just be on a pro rata basis. So Susan or the developer, depending on who's the owner at the relevant date, would be entitled to an exemption for 2/40ths of the windfall gains tax liability. Right, I think we'll move on to the next slide, which is the second example. So this example is just designed to tease out some of the inconsistent outcomes that we can see in terms of the deferral mechanism. So we have a company here, private company, Auto Repairs, that owns a vehicle repair workshop in Dandenong, a suburb of Melbourne. In July 2023, the land on which that workshop is located is rezoned from industrial to residential. So Jim, who is the sole owner of that company, can see the valuable opportunity that he now has as a result of the rezoning, and he decides that he wants to redevelop his land into townhouses for sale. But he wants to do that in partnership with an experienced residential developer because he's not a developer. He's never done any development, so he has the good sense to realise that he needs somebody with development experience to partner with him to make the best out of this development opportunity on the land. However, he also wants to retain control of the development, so he's not willing to sell the land in full. He's not willing to give up control of the land or the development process. He just wants to partner with someone who's going to assist him with the development. So after the rezoning occurs in July 2023, Jim looks at 3 different options in terms of proceeding with a relationship with the developer and the development of this property into the residential townhouses. The first of those options is that he considers selling a 49% interest in the land to a developer. So Jim and the developer would become joint owners of the land, Jim to 51% and the developer to 49%, and would proceed with the development on that basis. Now, based on the windfall gains tax legislation, that sale of a 49% interest when it completes would cease the deferral of the windfall gains tax. So assuming that in July 2023, at the time of the rezoning event, Jim's made an election to defer the windfall gains tax liability that he has on the land as a result of that rezoning event. If he completes a contract of sale for a 49% interest in the land to a developer, then notwithstanding he's only selling 49% and not the entire land, that sale and the completion of that sale is going to cause an end to the deferral of the windfall gains tax liability. So on completion of that contract, not only will there be a stamp duty liability for the developer acquiring its 49% interest, that completion would also result in the windfall gains tax deferral coming to an end and the windfall gains tax liability crystallising. Obviously, then we'd have a joint ownership situation, and hopefully the parties have, by that stage, worked out how that liability is going to be funded as between them, and presumably it would be on a 51-49% basis, but that would be subject to the contractual arrangements between them at that time. So it's that event, that option one, is one that's going to cease the deferral. It's going to cause a full crystallisation of that windfall gains tax liability on the property, and it's also going to cause a stamp duty liability for the developer. The second option that Jim's looking at is not entering into a contract of sale, but instead entering into a development agreement under which the developer would effectively step in and take responsibility for the development, given their experience with residential development. And for the benefit of doing all of that, incurring all of the costs, marketing the townhouses for sale, engaging all of the subcontractors, et cetera, that developer would be entitled under the development agreement to share a share of 49% of the profit from the sale of the developed land. So in that scenario, as Irina mentioned during her part of the presentation, a development agreement is not of this nature, which gives rise to an economic entitlement duty liability, and this kind of development agreement where the developer is sharing in the profit and getting an entitlement to 49% of the profit would give rise to a duty liability under the economic entitlement provisions in the Act. So the developer would have a duty liability as a result of entering into the DA, but that economic entitlement duty liability is one of the excluded dutiable transactions for windfall gains tax purposes. So despite the fact that the developer should end up paying the same or around the same amount of stamp duty as they would pay if they were to acquire a direct interest in the land, then by entering into a development agreement, the benefit of that is that it won't cease the deferral of the windfall gains tax liability. So contrast that to option one, contract of sale, completion of the contract, the windfall gains tax deferral ceases and the full liability crystallises. Under this option two, development agreement, still got a stamp duty liability for the developer, but the windfall gains tax liability does not crystallise at that point, and therefore the Jim in this case could elect to continue or would be able to continue deferring the windfall gains tax liability on that land until he actually completes contracts of sale for the developed townhouses on the land, obviously with the assistance of the developer. So the deferral of the windfall gains tax liability would continue to run all the way through until the completion of the contracts of sale in relation to the new townhouses which are going to be developed. The third option which Jim is considering is a sale of 49% of the shares in his company, so Auto Repairs Pty Limited. So rather than selling an interest in the land, he's considering a sale to the developer of an interest, an equivalent interest in the company, being 49% of the shares. Now, whether a developer is willing to consider that as an option is obviously a separate issue, given the potential issues regarding the existing company. But if they were, then that has a very interesting result both from a stamp duty and a windfall gains tax liability perspective. And from a stamp duty perspective, given that the developer is only taking 49% of the shares and assuming they don't otherwise gain control under the relevant contract, then that would not be a relevant acquisition for landholder duty purposes because it doesn't meet the 50% landholder duty acquisition threshold. Therefore, there would not be a duty liability on the acquisition of those shares. And furthermore, that acquisition or that sale of the shares would not cease the deferral of the windfall gains tax liability. So as with option 2, the deferral could continue all the way through until the contracts of sale of the townhouses complete, which would then crystallise the liability. But in the meantime, the deferral continues. We've got the developer effectively getting a 49% economic interest in the project through its acquisition of a 49% of the shares in the company, but not paying any duty on that acquisition. So you can see that if it worked commercially and perhaps taking into account other tax considerations, then it's possible that option 3 could be the most beneficial option, certainly from both a windfall gains tax and stamp duty perspective. Option 2, sort of the middle ground, would have a duty liability, but would continue the deferral of the windfall gains tax liability. Whereas option 1, which is probably the most straightforward, where the developer would take a 49% interest in the land, is not only going to cease the deferral of the windfall gains tax liability, it's also going to cause a duty liability for the developer. So, in broad terms, thinking about the fact that in all 3 scenarios, the developer's getting a 49% economic interest, if you like, in the project, and the ability to take a share of the profit, whether as a shareholder or a direct owner of the land or as a developer under a DA, then you can see that there are inconsistent outcomes that the legislation provides for in respect of these 3 different options. And it's certainly something that we are encouraging our clients to think long and hard about when they are bringing in developers or contemplating bringing in developers into their projects for the development of their land. Next slide, please. So just moving on before we get to your questions to look at a few of the areas and issues of concern that we've identified out of the legislation. So the first is the mismatch between the pre and post rezoning valuation methodologies. As Irina identified, the pre-rezoning CIV will be as per the general rating process and per the rates notice. The post-rezoning CIV value will, however, be determined pursuant to a specific valuation that the Valuer General will be instructed to complete after the rezoning event. And although the Valuer General will be instructed to value the land as at the same date as the pre-rezoning valuation, he will obviously have the benefit of hindsight in that regard. And our concern is that the rezoning process in respect of the the valuation process in respect of the post-rezoning situation will bring in other factors that may mean that the uplift is actually not just limited to an uplift that's purely occurring as a result of the rezoning event, but brings in other factors that may then bring in capital improvements in the capital value of the land. The second concern is about the transitional exemptions, and there's a couple of points here. One is that in our view, and it's water under the bridge now, but in our view, and we advocated for this while it was still within Parliament, the exemption cutoff should not have been 15th of May. It should have been at least at the earliest October when the legislation was introduced into Parliament, but that is what it is now. It is 15th of May. We also believe that it should encompass other commercial arrangements between the parties other than just contracts of sale and options to enter into contracts of sale. In our view, for example, development agreements, which we just talked about, are commercial arrangements that have been entered into prior to 15th of May. They are long-term arrangements. We have got clients that have entered into long-term DAs in respect of land that will be impacted by the windfall gains tax in the future. They were entered into at a time when neither party knew about the tax and the fact that the government proposed introducing the tax. So in our view, they should have been exempted, but they're not. Irene has already covered the broad grouping rules, and I think we've got one or two questions on that, so we'll leave that for questions, but they are very broad and they do give joint and several liability between the parties. There's obviously uncertainty regarding allowable deductions because we just don't have the list of allowable deductions as yet, and won't have that until the regulations are issued, as we said, most likely sometime next year. And then in terms of the intragroup transfers, we believe the exemption is too narrow. Irena has already referred to situation regarding an in-specie distribution of units, which, although it would be for no considerations, not covered in the excluded transactions. Another one would be a transfer of farmland between family members. Now, there is a duty exemption for transfers between members of a family or family group, subject to meeting the relevant requirements. But one of the requirements that doesn't exist is that it doesn't need to be for no consideration. So in order to be exempt from windfall gains tax purposes, that transfer of the family farm would need to be for no consideration. Now, it may be as between the family members for other reasons that it needs to be at cost or it needs to be at market value. It's still within the same family economic group, but unfortunately, it won't be exempt for windfall gains tax purposes, and it would trigger the crystallisation of the liability, so cease the deferral. Next slide, please. And just a few more issues. That we are really concerned about the impact of the deferred liability and what will be a first charge over the land on access to finance. Now, clearly there is going to be deferrals that are in place for a significant period of time between the rezoning event and when the deferral ceases and the liability crystallises. In the meantime, there will be a first charge recorded over the land for the windfall gains tax liability that will be of particular interest to financiers and others that are potentially lending in respect of the land and the projects associated with the land, and that's going to be something that needs to be watched carefully. We're also concerned about the inequity of this tax as between the growth areas infrastructure contribution. So land that's within the GAIC area is obviously not subject to the windfall gains tax, but the problem that we've seen, and it's been in the media while the bill was in Parliament, is that the GAIC liability sits currently at around the $120,000 per hectare mark, whereas estimates that have been made by experts in the industry, and clearly those experts have done a lot better modelling than the government did before they introduced this legislation into Parliament. Those experts predict that the windfall gains tax liability in certain regional areas of Victoria could well be double that amount. So somewhere around the $250,000 mark, for example. Compare that to GAIC liability of around $120,000 per hectare in the growth area. We really think that's an appropriate way of treating land in regional Victoria, and it's going to put a very severe handbrake on development of land in that area and impact housing prices as well. And finally, the interaction with the CGT provisions, that's a real difficult one at the present time. Now, I'm not an income tax expert, so just bear with me, but our wonderful income tax team here at Pitcher Partners has been looking closely at this issue, and unfortunately, there's no clear answer on this at the present time. So the first interaction that needs to be considered is whether the windfall gains tax liability will actually give rise to an income tax deduction. That will ultimately depend on whether the land is used to produce income or whether it's seen to be on capital account. That's obviously factually dependent. It will depend on the circumstances, but property developers are more likely to have their costs viewed on revenue account as opposed to investors. So the windfall gains tax legislation makes it clear that the windfall gains tax liability arises on a rezoning, and it's likely to be viewed for income tax purposes as being incurred at that time, whether or not that liability has been deferred, and it's irrelevant when the liability would be payable. So that could cause a number of compliance headaches from an income tax perspective in terms of having to go back and amend returns in past income years if the windfall gains tax liability is deductible. If it's not on revenue account, we then have to consider the CGT treatment of the liability, and this is where it gets really murky. The windfall gains tax does not easily fit into the cost-based provisions as they currently exist for CGT purposes. The second element, cost base, includes stamp duties and similar duties, but the windfall gains tax is, in our view, probably distinguishable from that and is unlikely to fall within that provision of the cost base rules. It could fall potentially within the third element, which covers costs of ownership of the land. However, this is limited in some ways as the third element costs are not taken into account where there is a capital loss, and also do not apply to assets that were first acquired before 1991. So it may well be that there needs to be a law change in respect of the cost-based provisions that deal with these issues. And unfortunately, this is not something that was, it appears, discussed between the Victorian government and the federal government at the time that the Victorian government decided to implement this new tax. It appears the feds weren't told about it and had no input in relation to its design and the potential interaction from a CGT or income tax perspective. So that's something to watch out for the future, but in our view, certainly as things stand at the moment, it is problematic from an income tax and CGT perspective. Next slide, please. So just a last sort of wrap up slide in terms of watch outs before we move on to your questions. It's obviously vitally important that if you're looking at a future contract of sale, option, development agreement, any other commercial arrangement in respect of land that may be subject to windfall gains tax liability post 1 July 2023, that you take it into account. You think about who's going to be liable, when's it going to be payable, consider how much the liability might be, and that's really the difficult point at the moment. But importantly, consideration needs to be had to this issue of the windfall gains tax liability now. Don't wait until 1 July 2023. Think about it in the drafting, speak to your lawyers and make sure that it's dealt with appropriately from a contractual perspective as between you and the other party. And as part of that, obviously, there needs to be a decision about who's going to bear the cost. Is it going to be shared between the landowner and the developer, for example? We've already mentioned the two-tier market between the gate land and the windfall gains tax land. That is a particular concern. We're also concerned about metropolitan Melbourne rezonings. There's been a lot of focus on the regional Victoria, but the windfall gains tax does apply across Victoria and could well apply to rezoning events that are purely initiated by the state or local government, where the landowner in the relevant precinct has no say in the rezoning because it's being driven by a particular state or local government initiative in respect of a particular precinct of metropolitan Melbourne. Now, in that case, unless the Treasurer uses his exemption power to exempt the relevant rezoning event from the tax, that is going to be caught, even though the landowner had no input into that rezoning event. In our view, that's inappropriate, and it's something that we'll need to keep a close eye on. And in terms of the other states and territories, well, who knows? You know, Victoria has been a leader, and not such a good way, in terms of introducing foreign surcharges, duty and land tax, and now the windfall gains tax. No doubt other states and territories will be keeping a close eye on how things develop in Victoria, and we'll have to wait and see what else might occur in other jurisdictions of Australia. So with that, thank you. We are going to now move into some of your questions, and I can see we've had a fair number come through. So we've got sort of 11 minutes or so, and I'm going to hand back to Irina, who's going to take us through some of these questions. Thanks, Irina.
Yeah, sure. Lots of good questions being asked. Thank you for all the questions coming through. There's certainly a lot of questions that are similar. So I think a number of questions in relation to the federal income tax and capital gains tax treatment or interaction with the windfall gains tax. So hopefully Craig's explanation there sort of addresses that question there. Basically, I think it's up for debate in short. I mean, the interesting thing there is that if lands on capital account and if the windfall gains tax does form part of the cost base, I suppose the Commonwealth wouldn't be too happy about it because it starts eating into and it starts eroding the Commonwealth tax space. So it'd be interesting to see what happens in that space. There are a few questions about the definitions of related corporations and trusts for the purposes of the grouping or aggregation provisions mentioned earlier. So these terms have particular definitions in the windfall gains tax legislation. Broadly, the definition of, for related corporations borrow the same concept and definition for land tax purposes. So it would include, one corporation controlling the composition of the board of another corporation, or holding more than 50% of the voting rights or shares in the other one that would associate both companies and make them related corporations or companies. It also includes where the same person or persons having a controlling interest in each corporation. Basically, as I said, have a look at those definitions. They have particular meanings, and whilst there might be some overlap as to what's caught for windfall gains tax purposes and perhaps what constitute a tax consolidated group, they do have particular definitions, and the windfall gains tax definition is quite broad. In relation to the definition of related trusts, well, trusts would be related if the same person or persons have a controlling interest in each trust. And basically a controlling interest is considered to be in existence where the person has the ability to control the appointment of the trustee of the trusts, or a person or person's entitlement is to more than 50% of the income or capital of the trust. So as I said before, these are particular definitions, they're quite broad, and I think will need to be examined quite closely in the context of trying to work out whether or not a few entities that you're looking at are related for the purposes of the windfall gains tax provisions. There's a great question here from Kate, Craig, about whether you can object to the CIV1 at the time the CIV2 is received, or do you have to object with the CIV1 notice that's issued earlier? So subject to your thoughts, my reading of that is that you should be able to object to both CIV1 and CIV2 within 2 months of the issue of the windfall gains tax assessment under the Valuation of Land Act. But it's a good question, I think, and we can double check that and circle back, Craig, but that's my understanding of.
Yeah, I think that's my understanding as well, Irene. My understanding is that given you will have a value uplift, which is obviously calculated as the difference between CIV2 and CIV1, then you must have an opportunity to actually object to the first part of that value uplift, which is the CIV1. So my understanding, like yours, is that you would be able to object to both of those valuations as part of the objection process.
Yep. Thanks for that. There's also another question about the valuation aspect. And the question is, what happens if the amount assessed under the windfall gains tax assessment is less than what the owner ultimately sells the property for when they pay the tax upfront or when the tax is deferred? So that's a great question from Sam. And the Act is silent as to that scenario there. And basically, I think based on the provisions that we have, I think that once the assessment is issued, well, you're stuck with it. And the ultimate sale price subsequent to that doesn't really impact the earlier windfall gains tax assessment. Of course, it can work the other way. For example, if after a windfall gains tax assessment is made, there's a decline in the property market or something in relation to a particular land assessed under that windfall gains tax assessment, there similarly is a mechanism for redress in that situation if the property is later sold for less than the supplementary valuation amount used to calculate the tax outside of the valuation objection process. If you can sort of point to the value used for the purposes of the assessment being deficient at that point in time. There are a few questions from Alex in relation to what acquisitions of economic entitlement or dutiable transactions or relevant acquisitions mean. These concepts are tied closely to the Duties Act 2000. So we won't have time to obviously give you a very comprehensive overview of the duty provisions, but basically within economic entitlement, as Craig mentioned earlier, the classic scenario is where you've got a development agreement. Say the developer has an entitlement to a percentage of the profits or the proceeds from the development that would fall squarely within the economic entitlement stamp duty provisions under the Duties Act. And that's what the acquisition of an economic entitlement can include, but it can be broader than that and could include other types of arrangements. Dutiable transactions would include things like transfers of land. Relevant acquisition, as mentioned before, it's a concept that's inherently linked to the landholder duty or land reach provisions. In a nutshell, it's looking at whether you've got a 20% or greater interest being acquired in a unit trust or a 50% or greater interest being acquired in a company that owns land worth more than $1 million. A few questions about the 2 hectare residential land exemption. There's a question from Paul about whether the exemption is only if the land is the owner's principal place of residence, or is there simply a 2 hectare exemption of residential land? The latter is correct, Paul. There is that 2 hectare exemption for residential land, regardless of whether that land is being used as the principal place of residence of the owner. So it can include investment properties. There is also a question, another one of what I saw. Yes, a question from Mark in relation to the 2 hectare residential exemption. The question is, or the comment there is, it would appear that the capital improved value is merely allocated on a pro rata basis over all the hectares being sold, rather than looking at the actual CIV that might apply to that 2 hectares allocated for tax purposes. If I've understood that question correctly, Mark, basically, if you look at the uplift in the value of the land that determines the size of your windfall gains tax liability, that value uplift for the entire land is a portion based on the size of the residential land minus the 2 hectares that's exempt. So it is sort of allocated or portion on that pro rata basis, if you like, minus taking into account the 2 hectares that you get exempt. There's a good question from Natalie Craig that I think is about a link to your commentary towards the end there. And the question is, how does FEPE see this as playing out or impacting the Victorian property industry in general terms? And I know you've talked a bit about that, but do you want to add further to what you said there before?
Yeah, no, absolutely. Thank you, Natalie, for the question. It's quite unknown, I guess, is the answer, but our real concern is that it's going to have a negative impact, particularly in the regional areas, and we expressed that as part of the advocacy work that we did at the time that legislation was in Parliament. But we're very concerned about the fact that obviously the regions are known at the present time for the most affordable housing in Victoria. And as I mentioned during my presentation, the projections that have been done by those in the industry that know suggest that the amount of the windfall gains tax that will be imposed on a per hectare basis is potentially double the amount of the GAIC that would be imposed on GAICable land. So that's a very significant impost, particularly in regional areas. And we've obviously got significant demand at the present time for areas, near Geelong, near Shepparton, near Bendigo, etc. So in our view, it's going to, these costs are not they're not held within the landowner or the developer. They're passed on down the chain to the end consumers, to the house purchasers, house and land packages, land purchases, and therefore we think that it's going to have quite a significant impact on housing prices in these areas in particular.
Thanks, Craig. Just looking at the questions, quite a few of them. There is a question about the subdivision sort of treatment of the lots subdivided. And the question from Roger is, can the liability be apportioned to every child title created, and therefore you pay the tax off as new titles are created and sold? Roger, the short answer is yes. The tax and interest are rolled over to each child lot created by the subdivision, and the liability of the parent title is therefore apportioned to each child lot by reference to the size of the lots created by the subdivision.
So I think that's talking, Irina, about a deferral situation, for example, where there may have been a liability incurred at the time of the rezoning event, but obviously that's there's an election made for that to be deferred until such time as the land has been developed and sold, and then, as you say, then there would be an allocation of that liability proportionally as the child lots settle.
Yeah, exactly. There's a question here about, is a WGT, so basically I think it's about whether there's a WGT liability if a contract and settlement occurs before the 1st of July 2023. It's just a note to watch out for, because the windfall gains tax is not a transaction tax, if you like. It's a tax linked to rezoning of land and whether or not the land value increases by more than $100,000. I suppose it doesn't really matter if you've got a transaction that occurs before that date. It's a question of whether you've got a rezoning that happens after that date that creates a value uplift of $100,000 or more. If you do have such an event after the 1st of July 2023, then the owner of the land at that point in time, at the time of the rezoning, will be liable for the windfall gains tax. So I'm not sure if that question there is coming from the perspective of, a vendor or, someone selling land before that date. But again, think about the rezoning being the relevant trigger point for the tax. And then the liable party is basically the owner of the land at that point in time. So if the incoming purchaser is on title by that date, then it'll be the purchaser's liability at that point in time as the new owner of the land. There are a couple of really good questions about whether or not other states are going to be doing something similar to Victoria in this regard. Well, Victoria tends to be a bit of a trendsetter, being the first one to come up with the foreign stamp duty and land tax surcharges. So other states may copy Victoria in relation to the windfall gains tax. So far, we haven't heard anything, but interestingly, the ACT actually has got a similar lease variation charge of 75% of the value of the land. And in the ACT, basically, they've got a leasehold system for tenure of land. They don't have a freehold system. And basically, we've got variations of leases. There could be this lease variation charge that applies there. But, as for a near identical tax to the Victorian windfall gains tax, I think it's kind of a watch this space sort of thing for now, to see if other states like New South Wales and many other states with budget deficits might one day copy Victoria.
Irina, sorry, we might, given the time, we're now passing over to 1:48, so we might have to cut it off there. So apologies to anyone whose questions we haven't got to. There's some really great questions there, and we're not surprised about the significant interest. We had more than 500 people register for the seminar today, so we really thank you for your interest. Thank you for your questions. If you do have further questions, we encourage you to please get in touch with your normal Pitcher Partners representative, and no doubt they will get Irina or I involved as required. But given the time, I wanted to say thank you very much for joining us. Thank you, Irina, for your presentation. Thank you very much to Robin for working the slides in the background, and Bella and Ange for all of the organisation of this webinar. And thank you all for your attendance. We do appreciate it. We know that this is going to be a very interesting and controversial tax moving forward. So we'll no doubt have further discussions with you, I'm sure, over coming months leading up to its introduction on 1 July 2023. But for now, we will leave it there and wish you all a good afternoon. Thank you very much for attending. Goodbye.